Okay, so today we're gonna be learning about a little thing called monetary policy. So what is monetary policy? Well, it's policies used to fight recessions and inflationary gaps. You guys remember those? We've got our recession right here. We've got our recession right here. This little gap is the recessionary gap. And we've got our inflationary gap right here. Now, how do we get everything back to normal? That's what we're going to learn today. First, though, we need to learn about the money supply graph. So, the money supply graph, money supply, looks like this. Okay, we've got graph. This axis is quantity of money. Quantity of money. And this side is nominal interest rate. Later on, when I start doing quick graphs, I'm going to label this NIR and this one QM. But remember, on the AP test, you're going to want to write the whole thing out. It's just so that the graders don't get confused. So, what does this graph look like? Well, we've got our demand of money, D of M, and our supply of money, which is a vertical line, supply of money. So, this is your graph. How do you label your equilibrium points? Obviously, that's the next thing you would probably have asked me. So right here, this comes over to this, and this will be what your nominal interest rate is. You label that lowercase r. Here, your quantity, simply quantity. So, what are the shifters? In this video, we're going to discuss Federal Reserve policies, what they are, and how they can shift the supply of money and demand of money. Let's get into it. This is going to go really quick, so pay attention. So, there are three main Federal Reserve policies. Number one, we have the required reserves. Required reserves. 2, we have our discount rate. And 3, bonds. The purchasing and selling of bonds. So, how did each of these affect that graph I just showed you? Required reserves. Let's go over that first. Required reserves. So here's our graph. Let's say for this graph we have increased required reserves. So the graph is going to react like this. If you increase required reserves, it's going to shift the graph. The supply to the left. Why does that happen? Quick explanation. Shifts it to the left. Quick explanation why that happens. If you increase required reserves, banks have to hold more money in reserves. They can't lend out as much money. Therefore, the money supply decreases. What effect does that have on interest rate and quantity of money? Our interest rate goes from here, right here, to here. That's an increase in interest rate. But our quantity goes from here to here, a decrease in quantity of money, which is what the goal was. And now, let's say we decreased required reserves. Well, the exact opposite happens. NIR, QM. The exact opposite happens if you decrease the required reserves. Supply of money shifts to the right, causing your interest rate to decrease, while causing your quantity to increase. That happens because now banks can lend out more money. There's more money in there's more money in the market, increasing the supply of money. Now, what happens for discount rate? It's very similar. I'm going to make this really quick because it's basically the exact same thing that happens to the graph for required reserves. If you increase your discount rate, you're going to cause the supply of money to shift to the left, increasing your interest rate, decreasing your quantity. And if you were to decrease your discount rate, this shifts to the right, this goes down, this shifts to the right. Same thing, different reason. Discount rate is the amount that banks charge for lending, that the Federal Reserve charges banks if they lend from it's the interest rate the federal bank charges on banks that borrow money from the federal bank. If they decrease that rate, then banks are going to be willing to borrow more money. Then there's going to be more money in the money supply. If they increase that rate, banks won't borrow as much, causing a decrease. Now, bonds. Bonds are banks. The Federal Reserve can sell bonds to banks and people. What happens so there's two options that the banks have with the Federal Reserve has with bonds. They can either buy bonds, or they can either buy bonds or sell bonds. And this buying and selling refers to buying bonds from the banks and people, or selling bonds to the banks and people in return for money. If they buy bonds, they're buying them back from the banks and the people. That's going to make the money supply go big. It goes so you remember that, buy big. It increases the supply of money. Now, if you sell bonds, it makes it small. They're giving people bonds in return for money. So if it goes small, it decreases the supply of money. Just really quick on a graph that's going to look just like it did with all the other ones. So buying bonds, this is buying bonds. You see this. It increases the money supply. Interest rate decreases. Quantity of money increases. You sell bonds. It goes this way. Shifts the supply of money to the left. Quantity of money decreases. Interest rate increases. Now, next topic is shifters. It is shifters of demand. So, how do we shift the demand curve of the money market graph? There's only a couple things that you can do. 3 things, actually. 1, change the price level. 2, change income, increase or decrease income. Or 3, increase or decrease personal taxes. This is not just taxes in general, this is personal. I should write that. Personal taxes, okay? So let's take a look at the graph. So, price level increases. Here we go. Boom. Boom. You increase the price level, the demand for money is going to shift to the left because now everything costs more. So, demand for money shifts left. That's not going to... all of the shifters of demand will not affect quantity. So if something says it's a shifter of demand, quantity, not affected. Okay? But your interest rate goes from here to here. It decreases. The interest rate went down because of this change. increase price level, this shifts to here. Quantity once again doesn't change, but interest rate increases. Now, next we have income. So, income, if you increase income, it's going to shift the demand curve to the right, causing an increase in interest rate. Nominal interest rate increases, and quantity once again stays the same. If you were to decrease income, so increasing it shifts it to the right, decreasing income shifts to the left, and you decrease your interest rate. Last thing is personal taxes. Personal taxes. So, here's what happens. You have your personal taxes, you have the graph. You increase personal taxes, it's going to cause a decrease in the demand for money. It's going to shift that to the left. That causes our interest rates to decrease. Now, if you were to decrease personal taxes rather, that's going to cause an increase in the demand for money, causing an increase in the nominal interest rate. Quantity stays the same throughout all this. Alrighty, that's it for this episode. We're going to talk about the effects that these policies can have later.